Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Anthony Woodside, Senior Solutions Strategist with LGIM America, to discuss tailoring the credit playbook for an unorthodox slowdown and Fed policy. Anthony, it's great to see you. Welcome back to Trade Talks.
Great to see you as well.
After GDP contracted for the first 2 quarters of 2022, there's been a fierce debate over whether the economy is already in a recession. What are your thoughts here?
Yeah, Jill, like you said, that's the polarizing question of the day. On the one hand, the economy definitely satisfies the technical definition of a recession. We saw the economy contract in Q1 and Q2. However, when you look at the more comprehensive test for a recession that's applied by National Bureau of Economic Research, it's a little bit less clear-cut. More specifically, if you look at Q1 and Q2, Q1 GDP contracted largely because of net trade. Q2 GDP contracted because of inventories with a little bit of help for residential investment. However, when you look at more broader measures, the labor market remains very strong, adding around 500,000 jobs per month this year. And then we also see job vacancies near record highs. So it's a very bit of a nuanced type picture, more so than some of the debate would lead you to believe.
So how should fixed income investors customize their investment strategy as we're going into what's an unorthodox slowdown heading into the fourth quarter?
Yeah, so that's a very good question. For us, I think it's important to establish the monetary policy backdrop. We saw in 2022, so far this year, we've had an inflection in monetary policy. More specifically, whereas investors could once count on the Fed to provide a floor for asset prices via the Fed put, now policymakers seem intent on imposing a ceiling on asset prices to curtail inflation here. So we think that's very important. And then when you look at some of the overseas developments, global central banks are also engaging in synchronized withdrawal of monetary stimulus. Now, in terms of positioning, what we've been doing, we've basically been defensive for more than a year in corporate credit, but we've recently moved to neutral. And there are a few reasons for that. One is if you look at valuations, of course, valuations have cheapened meaningfully this year. Spreads are around 50 basis points wider, depending on what index you look at. And then secondly, policymakers and the market in general has largely caught up to our view that if the Fed is serious on arresting runaway inflation, they need to get that terminal rate above 4% for this cycle. And then largely, if you look at the bearishness that we see out there right now in the market, there's a lot of money sitting on the sidelines and spreads are trading near year-to-date wides. So we think risks are skewed for a little bit of a positive surprise in the near term should we get any good news.
So Anthony, how have you tactically shifted your view in the short and long term?
Yeah, so if you look at the long term, for example, so I already touched on the short term, we've moved to neutral on a tactical basis. However, on the long term, Jill, we're still bearish. So one of the things we look at is we do believe that the economy is basically going to tip into recession in the second half of next year. And a couple of things we would point out to. One is we do think restrictive monetary policy, and we are moving to that environment, is going to lead to consumer retrenchment. And then secondly, when you look at sticky inflation, we do think inflation is going to be sticky. We think that that is going to weigh on corporate margins here. So what we've been doing is we've basically been orienting our portfolios to more defensive sectors. And even within our investment grade portfolios, some of our higher beta triple B names, for example, we are largely making sure that they have identifiable positive deleveraging catalysts that we can point to, or else we're going to pare back generic triple B risk.
So when you talk about with more defensive sectors, you are looking for debt within the utility consumer spaces?
That's exactly correct. That's exactly correct. So right now we've been oriented a little bit more to defensive countercyclical sectors like pharmaceuticals, utilities on the margins. However, we do like some other sectors like midstream. We think that midstream is going to continue to hold value here. It's not as volatile as the E&P sector, for example, in the energy sector. So we like that. And we also like banks here. Banks, if you look at basically relative value opportunities versus industrials here, banks look very attractive when you look at the historical spread differentials there.
Okay, Anthony, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.